so in love with you.
Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. It's going to be Cathie Wood of ARK Investment basically talking about the housing market fraying at the seams and on a possible recession. Now, as you guys know, I believe we're in a housing market bubble being fueled right now by low inventory and massive fear and emotion of missing out. And I believe that all of those things combined is essentially going to lead to a recession, which will then lead to a massive bubble pop, unlike anything we've ever seen in the history of the US housing market. So it's going to be interesting to hear her thoughts on the housing market and also her thoughts on a potential recession that's right around the corner. Obviously, a lot of people have been talking about the 2 and the 10 inverting and how long after an inversion is a recession typically happen? When does that essentially happen? Now, all of this I think is very important, especially if you're going to invest in real estate, because right now may not be the time to invest. You may want to sit out for just a little bit so that we can start purchasing on the flip side of the market. A lot of times at the flip side of the market, people can make a ton of money and basically get the home of their dreams. So there's nothing wrong with that. Now, you guys, as always, I am not a financial advisor. I'm an opinion sharer, realtor in Houston, loan officer in Texas. And if you can, for the algorithm, please like this video, you guys, share it, subscribe to my channel if you haven't. And as always, comment on your thoughts of our current housing market and your thoughts on the date of this video. Obviously, this video is going to be in my description below if you guys want to reference the entire thing. It's a great video. I believe she's a little bit more conservative. Obviously, she works for an investing bank, so she kind of plays down some things, I think. But essentially, the writing is on the wall. Let's take a listen right now on what she has to say about the housing market.
Two sectors that have been very strong, but are starting to fray at the edges. And we need them to stay out. In order to stay out of recession, we probably need these two sectors, housing and capital spending, to continue at a fairly strong pace. We're seeing some fraying at the edges. While housing starts were up a big 6.8% in February, permits were down 1.9%. Existing home sales were down 7.2%. New home sales were down 2% after an 8.4% drop the previous month. Pending home sales are down both month to month and year over year. And mortgage applications have been dropping for 2 months. So while housing prices are still up nearly 20%, according to the Case-Shiller indexes, on a year-over-year basis, and there probably still is a shortage. Maybe the prices are taking people out of the market.
You guys, essentially, even she is saying, kind of a conservative investor, that the housing market is fraying at the edges, and if not fixed, will lead to a recession. But let me ask you this. How can it possibly be fixed? There's no supplies, there's no inventory, and affordability has been destroyed. How can you fix that? But not only that, she's also indicating that sales are down across the board, which obviously does not spell signs of a healthy housing market, which is essentially what she's saying we need in order to stay out of bad things happening like a recession. Now, obviously, we can pretty much all agree that the 2008-2009 recession destroyed home prices. As a result, I know of loose lending standards and things like that, but the recession was no good. That's been proven essentially in our last recession, where the average median home price lost over 10% in equity. And here's the thing, guys, 10%, when people look back at 2008, they don't remember 10%. They remember 30 and 40%. I myself lost 40% home equity, $300,000. The problem was I lost my job as a result of the recession. I could not make my mortgage payment and I could not sell my house because I was upside down on my house. So I couldn't sell. So essentially that led to a foreclosure, which essentially led to 10 years of financial struggle for myself. So I don't want you guys to go through that. I don't want to scare you guys. I want to equip you and say, hey, if there's any way you can slow down, if there's any way you can save and pause or just stay put, if you already own a home at a really low interest rate, stay put for a little bit. Don't invest, because like 2008, we're in a pretty big housing market bubble. It's a recession's fixing to hit. I believe that recession is going to be the catalyst that pops the bubble. But Let's talk a little bit more about a recession. Let's hear what Cathie Wood has to say about the 210 inversion and what that possibly means as far as a recession coming. Let's listen now.
Very importantly, with the employment report, the yield curve, twos to tens, as I started talking about earlier, inverted. And again, that's a warning to the Fed at 2.35% on the 10-year Treasury bond. Which tends to track nominal GDP growth over time. So 2.3, 2.4%. That is telling the Fed, the bond market actually is telling the Fed, look, we think growth and inflation are going to be lower than expected. So be careful. We've been amused over the last, I would say it's maybe 2 months, that once the twos to tens started to invert, there was a shift by people who just wanted to be bullish on activity and growth and value stocks, a shift to the 3-month versus 10-year. Well, we've studied that, and the twos to tens, so that yield curve, is a leading indicator for the 3-month to 10-year Treasury yield curve. So I don't know why everyone took that jog at the same time. It was, as I said, amusing. But just know, at least from our point of view and from our research, the one that we place a higher priority on or place more weight on is the twos to tens. It's inverted. And in post-World War II experience, every time the yield curve has inverted within 12 months to 18 months, we have been in a recession. So that's consistent with the inventory and output dynamic I described a little earlier.
You guys, so essentially the inversion of the 210 is a warning sign for the Fed and everyone else that it is possible and highly likely actually that a recession is coming. And historically, in as little as 5 months, as long as 1 year and 11 months. But historically, you guys, it is highly, highly likely a recession is coming. Now, remember, the 210 is the leading indicator of a potential recession coming, not necessarily the 3-month. The 3-month is important, but it is always, and in her eyes and a lot of other people's eyes, the 2 and the 10 inversion. So you guys, essentially, even with low inventory, there's a great possibility of a recession and a housing market crash. In fact, what I am specifically saying is it is because of the low inventory. I know topped with the fear of missing out, but it is essentially because of the low inventory that the housing market bubble got so bad. I don't think we would have such a massive housing market bubble unlike anything we've ever seen if it wasn't for the low inventory. Now, remember this also, guys, inventory is actually going to start increasing, in my opinion, from here on out because we're entering into spring and summer months, which is historically the biggest months for listings coming back on the market from resale houses. So we're fixing to get an inventory increase from there, which is what we need essentially for all of this to play out. Plus, foreclosure bans have been listed. So we are going to get a surge of foreclosures. I know that takes time, but nevertheless, there will be a lot of inventory coming from foreclosures. And I think that only goes up from here. Not only that, we are going to start getting surges of inventory from all of the new builders who have been building since 2021. Massive amounts of permits have been attained. And I believe potentially a lot of the buyers that they currently have under contract are going to fall out of contract. Regardless, you guys, supplies are going to start going back up. Now, I've been saying this, affordability is the biggest risk factor for a housing market crash. Now, obviously, inventory is going up. Demand has been rug pulled essentially because of inflation and surging interest rates. So all I'm saying is this, my opinion is this, stay patient. I believe the people that are staying patient will have the biggest results, the best results, and will be the biggest winners of a potential downshift in 2023 and the end of this year. So you guys maybe pump the brakes a little bit, stay patient, build your credit and credit worthiness, save your money, rebudget, and love your family. That's always going to be my opinion, you guys. It's the same thing. It's just the thing is we need to do it. There's so many distractions. Now, I hope I gave you guys some insights here and some education and some really good opinions. Now, if you can, like I said, comment below. Now, if you're out there or if you want to invest in real estate, I wish you luck and I hope you win.